Good morning, everybody, again, and welcome back from your coffee break. I hope for those of you that are on different time zone, the coffee is not going to be too strong, so you can take a rest at the end of the day. We have two papers in the session, two great papers on capital control and income inequality and the composition of liability and capital controls. Just a reminder on the rule of engagement: presenter 15 minutes, discussant 15 minutes, and then Q&A. Both participant, panelists, and attendees are invited to submit questions and comments on the chat, and then we will call them live during the discussion. So, Mark, take it away, 15 minutes.
Great, thanks, Alessandro. So this is a paper that is co-authored with my colleague Zheng at the San Francisco Fed, as well as Jingyi Zhang, who is at the Shanghai University of Finance and Economics. And of course, the disclaimer applies that our views are our own and not those of the Federal Reserve. So this is a paper on capital controls and income inequality. And let me start by talking a little bit about what we bring to this idea. So there's been some evidence coming out. I think we're going to add to this evidence, linking the idea that during these episodes where there are surges in capital flows, there are also notable movements in income inequality that one can find in the literature. And so an earlier paper on this was for Seri and Lungani, and they indeed found in a big cross-section that liberalizing capital controls were found to exacerbate income inequality. And, so what we're going to do in this paper is we're going to try to come up with a model that's going to be able to tell that story, and then try to take that model to data not only on policy movements, such as for Seri and Lungani look like, but actually on the flows themselves, and ask the question, do we see this in the data in terms of a relationship between capital flows and movements in income inequality? And of course, if you're going to write down a model like this, you want to worry about financial frictions and other policy distortions, and we will in the paper. And so, so what we think of this paper is one that moves on from what is now essentially kind of a widespread view that surges, in particular in capital movements, can have adverse implications for macro stability. But what we're going to look in this paper is actually the same surges can actually impact on income inequality. So how we're going to get there is we're going to look at a very simple overlapping generations model. Is kind of the simplest model we could use to try to get at this question. So we're going to have heterogeneous agents. We're going to have both households and entrepreneurs in the model. And then we're also going to have banks, because we need to have these financial frictions. But the banks are going to be not completely dummy banks, but they're going to be pretty simple. They're going to be competitive. But there are real resource costs of intermediation that I'll talk about, a la Curdia and Woodford. So, and within that framework, we're going to look at the impact of capital account restrictions in terms of taxes on both inflows and outflows separately. So we'll have implications in the paper not only for net flows and income inequality, but also for gross movements of one and the other. And just to preview the theoretical results, what we're going to find is that the short run and long run impacts of capital controls actually differ. The short run is kind of what we expect. If there's a short run shock to capital flows, and in particular a shock to capital inflows, that is going to exacerbate income inequality in a small open economy. And outflows actually mitigate that inequality. But in the long run, what we find is that relaxing controls on either inflows or outflows is going to reduce income inequality. So the long run results are much akin to the old literature like Chumley and Judd, this idea that even for households that save, it's kind of a bad idea to tax capital, and that's what's going to happen here. So we're then going to take that theory to the data, and we're going to confirm those predictions in a cross-country panel. We have a large cross-country panel of emerging market economies, 87 of them from 2000 to 2018. And what we're going to do is we're going to look at the impact of private inflows and outflows on income distributions as measured by the Gini coefficient. But of course, as we all know, especially the group that is joining for this session, capital inflows and outflows are one of the most endogenous animals that one could look at in empirical work. And so we're going to need an instrument. And so what we're going to use is actually changes. We're going to think in terms of a small open economy, and we could talk about that. But we're going to think in terms of an instrument through changes in 2-year treasuries. So the idea is that the Federal Reserve is acting on its own kind of to influence global interest rates based on what's happening domestically. And then we're going to interact that interest rate movement with remoteness as proxied by great circle distance from New York City. And the idea being that countries that are most sensitive to those changes are going to be countries that are closer to New York, and probably that means by the gravity equation they're trading more. And I won't have time to show you here, but we will test this. We do test this in the paper, and it works well in the first stage, and it also gives us the results that we expect to get. Because we want to look at inflows and outflows separately, we also need a second instrument. And so we also look at regional dummies. Our idea there is that's not too heavy-handed, particularly for this long period, and because we're looking at the impact on changes in flows, but that'll be our second instrument. So what we find is that indeed we find a statistically and economically significant impact of inflows, which are positive, and outflows, which are negative, on income distribution. And it's robust to a large variety of tests. So it's related to a lot of literature. Just to go over the themes, and this is not even as complete as the literature review in the paper, but we look at distortions from capital account restrictions, the idea that I've done some work with Zheng previously on using capital account restrictions as a macro policy tool, but also in terms of how if you have undeveloped financial markets, you might be less adept at handling capital inflows, and our results speak to that as well. So let me give you a very brief picture of the model. As I said, it's a very simple model. There's only two types of agents. There's households and entrepreneurs. Households are going to work when they're young, and they're going to save. And they can save two ways. They could save through deposits in domestic banks, or they can save by putting their money outside in foreign banks. But if there's a tax on capital outflows, that's going to be subject to the tax. The banks are going to intermediate these deposits and then make loans to the entrepreneurs who need the loans for working capital, and they can borrow from the domestic banks, but they also can borrow from foreigners. The foreigners lend to the entrepreneurs in a frictionless manner, but they are subject to taxes on capital inflows. And so that distortion is considered that way. So just in terms of the households, I'll just stress where things are non-standard because time is very short. The household utility is going to be consumption when they're young and when they're old. The budget constraints are pretty straightforward in terms of borrowing. Here, Tau D is the tax on foreign outflows. So the households, they can either borrow domestically and earn RD, or they can borrow abroad and they earn R star, the foreign rate of interest, but it's subject to the tax. And there's also this bequest motive from old to the next generation young. That helps us with our simulations, but it's not really germane. And indeed, we can get similar results qualitatively without them. So what happens in the model is that there's a wedge between the foreign interest rate and the domestic interest rate because of the restriction on putting assets abroad. So that results in banks paying less interest on deposits than than households could earn in absence of taxes by putting their money abroad. In terms of the entrepreneurs, they also have a similar utility function, and they have a quadratic adjustment cost of investment. But besides that, and then they invest and they consume out of the resources of their capital investments. But besides that, they're just similar to the households, and they also have a similar bequest motive. The capital stock follows a standard law of motion. In terms of the banks, as I said, the banks are competitive, and there's going to be this Cordia-Woodford real resource cost, and that's going to imply a credit spread. So what do we get out of this? Well, what we show in the paper is that if there's a shock to capital inflows in the short run, that's going to increase inequality, and that's going to skew income in favor of entrepreneurs. On the other hand, if there's a shock to outflows, that's going to lower inequality, and that helps the households. Basically, what that does is households have the banks have to raise the interest rate to keep the domestic depositors, and that raises their return on deposits. And so these two together, if we look at a net shock, for example, from a decline in the foreign interest rate, that's going to end up with the same as an inflow shock alone, the gross effect. It's going to skew income in favor of the entrepreneurs. So in terms of the empirics, as I already said, we're going to have a large cross-section. Because endogeneity is a big issue, we're going to IV. The first instrument is the change in the 2-year Treasury of the U.S. interacted with distance to New York City. But we need 2 instruments, so then we have 3 regional dummies, one for sub-Saharan Africa, one for Asia, and one for the Western Hemisphere. The constant term then could be interpreted as Central Europe and other random emerging market economies. We also include a battery of conditioning variables in the second stage, and we cluster by years. So here's our baseline specification. We're basically our variable event. We're looking at the growth in the Gini, and we want to look how it applies to the inflows and the outflows, subject to these conditioning variables. And we're going to look at net alone. So in terms of the results, just the punchline here, we see, yes, we get a positive impact on the Gini, which means more inequality on private inflows, a negative and significant coefficient on private outflows. So individually, inflows and outflows do affect income inequality in this cross-section in the predicted manner. And if you look at the numbers here, it's kind of, it's significant, but it's not crazy in terms of how significant. So one standard deviation increase in inflows, for example, raises the Gini by 1.35 percentage points. And we get a similar thing for net inflows.
Mark,
and then we
2
do
minutes.
robustness. Okay, we do robustness testing. We drop the conditioning variables to show that that's not driving our results. But of course, when we drop the conditioning variables, we get a much larger sample. So we then drop the conditioning variables and use the same sample. And in particular, when we get a larger sample, we get more countries. So it's a different set of countries. But either way, the qualitative results are the same. I don't have time to talk about that. So we then do optimal policy. When doing optimal policy, we think of a Pareto weight planner, where omega is how much they value household versus entrepreneur income. And basically, the two punchlines, tau L1 is the tax on inflows, and that goes up as that for subject to a decline in a short-term decline in R star. So in other words, when there's a surge in capital inflows, the more the planner cares about households, the more they try to restrict capital inflows. And then for outflows, they also restrict outflows, but less so the more they care about households. So that goes in the direction that one would expect. So I'm running out of time, so let me conclude. So we introduce a model of a small open economy with heterogeneous agents and financial frictions, and we show that in that heterogeneous agent model, capital account liberalization does impact on income distribution. But we get a different result for the long and the short run. In the long run, both types of agents want more liberalization. In the short run, there's a trade-off where surges and inflows help the entrepreneurs, but at the expense of the households. And these predictions, as I just showed you, are supported by the data and are also, I didn't have time to show you, robust to a large battery of robustness checks that are in the paper. Thank you very much.
Thank you, Mark. Right on time. We have Kosuke Aoki from the University of Tokyo discussing the paper. Kosuke, 15 minutes.
First of all, thank you very much for inviting me to this great conference, and I really enjoyed reading this paper. And so research question is, so they draw implications of capital account policies for domestic income distribution. And I think this is a very interesting and it's also a new question. And also they investigate this question both theoretically and empirically. So that's a very nice combination of theory and empirics. Okay. So let me try to summarize what they do. Okay. So it's a two-period overlapping generations model and entrepreneurs and households. Okay, so there are two different kinds of people. And so for simplicity, labor income, so wages are identical between the two agents. Okay, but their capital income, it's going to be different between the entrepreneurs and households, because households save and entrepreneurs invest in capital. So therefore, the return on capital of the entrepreneurs, return on saving, return on investment is given by RL. So that's this one. Okay. And for the households, so returns on savings is deposit rate, which is denoted by R. Okay. So therefore, in the model, the income distribution is mainly determined by the difference between those two rates of returns. And therefore, policies affect income distribution by changing the difference between the investment return and saving return. Okay, so that's what's going on in the model. So how is the difference determined? So the three equations are important to understand the difference between the saving rate and return on investment. Okay. So the first one is the kind of arbitrage condition for the savers. Okay, so R star is the world interest rate, and R is the deposit rate. Okay, and capital outflow tax changes, so makes a wedge. Okay, so that's tau D is the outflow tax. Okay. And for the investment side, so in order to borrow from abroad, the government imposes inflow taxes. Okay. So therefore, the second equation, okay, so mainly determines the return on capital. Okay. So here tau L is inflow taxes and tau D is outflow taxes. Those directly changes the difference between R and RL. Okay. And the other two endogenous variables, so risk premium, that depends on how you borrow from abroad, okay? And the financial intermediation cost, that's how much you borrow compared to the size of the economy. So those two factors endogenously change the wedge between the saving rate and the return on capital. Okay. And the main theoretical results, okay. So permanent capital account liberalization that reduces those two taxes. Okay, so that kind of policy improves economic inequality, income inequality. That is because the gap between the two returns, okay, saving returns on deposit rate and investment returns, those are becoming similar. So any policies that makes this gap smaller improves income inequality. Okay. And also, they show that the temporary surges in capital inflow increases in inequality. And this is mainly driven by temporary changes in the price of capital that increases the return on investment, okay? And vice versa for the capital outflow. Okay? So those are very nice results. And from the, so I like this empirical part the most. So they collected very rich panel data from 87 emerging market economies. Okay? And their measure of inequality is income Gini coefficient. Okay? And they pay attention, or they analyze effects of private capital inflows or outflows on this Gini coefficient. Okay? And the results are statistically significant, and also it's economically significant. Okay? So capital inflow increases the Gini coefficient, and capital outflow decreases the Gini coefficient, and those are consistent with the theory. Okay. And yeah, as I said, I think this is a very nice paper, both from the empirical and theoretical point of view. And in particular, empirical analysis is very rigorously conducted. Okay. And I think in terms of comments, I think the relationship between theoretical predictions and empirical results could be combined better. Okay? And what I mean is the following. So the theory part, so income inequality is purely driven by the inequality of capital income. Okay? And also they have nice predictions on both on long run and short run. But turning to the empirical part, their measure of income inequality is the Gini coefficient. And it seems to me that they only analyze short-run effects of capital controls of income capital flows. Okay? And in terms of the Gini coefficient, we know that income Gini coefficient can be affected by many other factors other than the rates of return on savings. For example, if we pay attention to the capital account policies, and that policy can affect wage distribution, because capital account policies may affect differently to skilled versus unskilled workers, or it may affect tradable and non-tradable sectors differently. Okay. And also, in particular, capital outflows can affect people differently with different unemployment risks. Okay? So those are not really captured by the model, but it can affect the Gini coefficient in empirical part. And so as I said, the paper is very, very careful about identifying exogenous changes in capital inflows and outflows, and they use very nice instruments. Okay? And so when I was reading the paper, they carefully said that those are shocks to capital inflows and outflows. Okay? But those may not be necessarily always equal to policy shocks, which the paper's main focus. And the exogenous changes of inflows and outflows the paper identifies can be driven by other structural shocks, such as risk shocks. Okay? So therefore, even though the paper is very clear about the effects of exogenous changes in capital inflows and outflows, it may not be necessarily equal to the effects on shocks, policy shocks. So if we are not, if we wanted to be clear about effects of policy shocks, maybe we could employ some narrative approach combined with the identification, the answers conducted in this paper. Okay. And finally, so the paper also has a nice section on optimal policy, optimal capital, income, and outflow taxes. Okay. But having said that, they assume a very simple policy function, which is defined in terms of the starting value of taxes and the goal value of taxes. And so they connected between those two values. Okay, so they find optimal values of those two initial and end values of taxes. Okay. So even though this is nice, I think it may be more informative and easy to interpret if you put the policy reaction function in terms of goal variables. So this is similar to Taylor in monetary policy literature. Okay. So in this case, goal variables can be capital inflows and outflows, or if the government cares income distribution, those policies can be a function of income, the measure income distributions. Okay. And also, so this is a nice section on optimal policy. But for example, we could employ the results of optimal policy to assess whether the actual policies we observe in reality are good or not. Okay, so this is I think this is further avenue to do for research. And thank you very much.
Thank you, Kosuke. We have a question in the chat, and I invite everybody else to add from Jingyi. Maybe we take that question, and then Mark, you can respond to Kosuke and to Jingyi as well.
Can I actually ask a different question from the one I have in the chat?
We give you permission to ask both of them.
The question is like, so I wondered whether the way intermediation cost is modeled matters for and the type of capital flow you think about matters for the conclusions. For example, currently you are thinking about the capital account liberalization as simply reducing costs on either inflow or outflow, but a part of the capital account liberalization can be more competition from foreign banks that potentially can depress the gap between the lending and the deposit interest rate. That will also have an impact on your notion of income equality. Right, that's not currently in the model yet. And the other is that the trade-related trade think about income equality as a return to capital relative to wage. Then that opens up a different kind of discussion about how various kind of liberalization moves affects capital return versus the wage, which is potentially different from the return on deposit rates, right? So these are potential enrichments that you might consider. Thanks.
Mark.
Okay, thanks, Alessandro, and thanks for the questions to both of you. Kosuke first. Those were very nice discussion questions. The first question, we've worried about this, because of the fact that it's very challenging, to get good data for a broad set of emerging market economies. We don't want to start looking at advanced economies other than the Gini, and even the Gini is kind of sparse in terms of time coverage, and there's a lot of gaps in the data. But, that's what we have. One thing we're thinking about doing now actually is exactly along, in response to this problem that you're raising, is to move a little beyond this just identical returns to labor of the households and the entrepreneurs. And so we're thinking in terms of, more like a CES, where maybe the returns to entrepreneurial wages are actually more, tied to the fortunes of the entrepreneurial sector or something like that. And then you could break that equivalence and it'll go in the same direction. So I think the next version of the paper will have an extension along those lines because it's a very good comment and it's one we've heard before, but that doesn't make it any less good. But on the empirical side, there's little we can do. So we have to try to deal with it on the theory side, I think. In terms of the long run, that's a really interesting question. It's definitely the case that our empirics are more conducive to dealing with the short run shocks. And I think most of the attention in the literature is like where we're looking, in terms of surges and those things. But one thing that occurs to me is that the Furseri and Lungani kind of results, people looking at the impact of policy changes might be more conducive to addressing long-run questions. And so maybe there's room for doing something in terms of policy changes, although they've done something already. But I think that's how I would tackle it if I was going that direction. In terms of the policy shocks, you know, I might be a little less worried than you, but not completely, because of the fact that we're doing, you know, we're limiting our sample to emerging market economies. And some are larger than others, but you know, it's pretty decent sample for a small open economy assumption. That all being said, you know, it's possible to try that, but of course, when you're doing that, you're going to introduce other errors in the data, and so it's a mixed bag. So I think for the set of sample we have, I would stick with what we're doing, at least as the main one, but it might be a very useful robustness check. In terms of optimal policy, you're right, and my only excuse is that we couldn't solve it with a more robust type of policy rule. And so what we really wanted only to get out of the analysis, and I see I'm running out of time, is just to show that the short run was indeed different from the long run, as our theory suggests. And indeed, that result does come out in the optimal policy part. And then just for a minute, because I wanted to say to Sheng, thanks for both of your questions. Your first one, you're right in the sense of in our paper, it does have always the domestic deposit rate is below the R star abroad, and to have something else without having a bang bang kind of result, we would need other financial frictions. So that in this one, it's just the wedge that's caused by the tax on capital outflows. But in terms of your second question, that's a really interesting thing to think about. It's a different channel, and it may well add some opaqueness to the kind of stark results that we get, in the sense that it might even be good for households if liberalizing can reduce the cost of intermediation. Then the banks, because they're competitive, would have to pay the households a higher deposit rate. And that might, make the results a little more ambiguous. So that's an interesting idea. Thank you very much.
Thank you, Mark. We have Chang Ma asking about the notion of optimality, if I read the question correctly. Zhang, you want to elaborate?
Yes, very nice paper, Mark. My question is that I was wondering, what is the effect of optimal capital controls policy on inequality? Because I was wondering, maybe there naturally exists some optimal level of income equality in this model. So once you solve the optimal capital controls policy, I was wondering how does that change the income equality in the economy compared to an economy without any regulation?
So when you're talking about optimal policy in our context, it's a loaded term because of the fact that we have heterogeneous agents. So you're going to have to take a stand on what the loss function of the policymaker looks like. And so the results that we have are in terms of the more or less the relative weight that the planner puts on the fortunes of households relative to entrepreneurs. We can compare across those weights, those Pareto weights. And what we get is that, as you might expect, for a short run shock, when the entrepreneur cares about the households more, there are more. Optimal policy calls for more restrictions on capital inflows, and when they care about the households more, they also respond to the shock by raising the taxes on outflows. They want to protect the banks to some extent, but they turn it around much more quickly for the long run because of the fact that these households also want to see more liberalization in the long run. So in terms of this really simple policy rule that we're using, where you just have two horizons you could optimize over, we see in both cases the planner worrying about the households in a relative extent, as we would expect.
Okay, thank you.
Thank you. Yushin was inquiring about your instrumentation, but I think then he corrected himself. Yushin, you want to still intervene? Yushin? No? So let me.
Oh, she didn't think it was time varying, but then she said she realized it is.
Yeah, because it's interactive.
It's time
with
varying, and then the remoteness we need as well, which it might be a little heavy-handed, but you need differences across countries. So
yes,
that's how we get there.
Yes. Other questions?
Can I ask you a very simple, like maybe the tiny technical question? So that I may be wrong as usual, but I think you are using the very simple overlapping generation model. So the I think a time in your model is like a 20 years or 30 years. So that because the reason why you have a OLG is just to have a financial friction. But if I literally interpret your model result and the empirical result, I think even in a model, it's almost like a very long run result. So maybe nice to discuss even if you have a OLG model with a stochastic transition or OLG model with a 50 generations, so your result remain valid or something. So that's my simple question.
No, that's a fair call. And to be completely honest, in the theory, when we go to calibrate the model, we think of a time period as about 10 years, and then we throw it to the data with annual data. So that's fair enough. And so there is some tension there between the length of a period in the model and looking at single year empirics. And so there's room for something like you say, like a stochastic trend or something like that. That's a good comment. Yeah, thank you.
Okay, thank you.
So that's really interesting, Mark. Thanks. There's an old story from the last financial crisis that income inequality would, drive a credit boom, which would cause a crisis. Now I know you got a nice instrumental variable, but I think the way to attack, that older story and things like it would be to recognize that your IV might be kind of in the spirit of a local average treatment effect, and that this shock might not affect each place the same, and it could interact with either rising inequality already or just any other number of variables. So one would want to see some sort of maybe you can define a treatment, discrete treatment, and do a propensity score matching, or do something a little more interactive. Have you tried something like that?
So we haven't done any kind of that, but we can try some robustness for propensity scoring. I think that would be a useful thing. I'm sympathetic to the idea that I'm pretty confident that the IV is exogenous for most of the countries in the sample, and so I'm not that worrying about endogeneity that way. But in terms of what you're saying, it could be some big shock that's moving all these things around, including the Gini coefficient, and so that's why we felt like there's no way to even begin to embark on this question without doing something like an IV, and that might be a useful robustness check to do, something like a matching kind of treatment to try to get at this question as well.
So, Mark, one clarification on my end. Do I understand correctly that the regression are specified as static? There's no dynamics in the regressions?
No, there's no dynamics at all.
Would it help resolving this issue of distinguishing between the short and the long run? Because as a static regression, essentially you're picking up the long-term relationship, even though you're estimating annual data with some dynamics. You would have transition, and then you could work out what is the yearly impact, and then what is the longer term impact over a longer period of time.
Yeah, so in principle, I completely agree with you. In practice, as we're using as a robustness check, we don't use it in the default specification, but we're using your data, so you know better than I do that this data is extremely noisy. And if I was trying to fit that many parameters, I don't know what kind of results I would get, but something. Maybe looking at 5 year or something like that, you could do it without looking at too many parameters. That might be something to think about. Yeah, but the short answer is, by adding a lot of parameters is going to make it very challenging for to get anything out of this sample, I think.
Do we have other questions for Mark? We have a couple more minutes.
No, but those were great questions. I was hurrying in my responses, but I want to thank Kosuke again and all of the other people who made comments. Those were really, nice questions and some things to think about going forward as we extend the paper. Thank you.